Good day there to you folks. Alright, so in this video I'll be teaching you how to master liquidity and stop hunts in the forex market. So now, have you ever placed a trade, you set your stop loss and you watch the market move and take you out only for the price to reverse in your direction and then boom, the other way around? Well, that's not a coincidence, guys. It's a liquidity grab, and today I'm going to show you how the big players hunt stops and how you can turn this into your advantage. You can take this into an advantage for your trading. Alright, so make sure you don't forget to like, subscribe and turn on notifications so you never miss a powerful trading lesson. Okay, now what is liquidity? Liquidity is the availability of buyers and sellers in the market. The market moves towards liquidity because large orders need liquidity to be filled. Okay, what does that mean? The big banks and the hedge funds, private equity, they place large orders in the market, and then for them to move these large orders, they need to take out stop losses of retail traders who are in the markets, like petty traders in the market, who need to be swept out before the market moves in the right direction. Okay, so now key liquidity areas are found in the previous video. We had support and resistance, which is the past highs and lows on the charts where those orders are resting. You can find liquidity on these areas. Likewise, you can find them at round numbers, which is the psychological levels on the charts. Probably for gold now, for Euro USD, you can find it at areas like this here, 10900, 101,000, like that. Those psychological levels are the areas where you find this liquidity in the market. Okay, so a tip for you guys: liquidity zones act as magnets for price. Those liquidity areas, price seems to magnet to those areas multiple times in the market. That's a way for you to find out those liquidity zones. Now, how stop hunts work and why they happen. Market makers and institutions need liquidity to execute large positions, like we said earlier. So they push price to those liquidity zones, then they grab their orders before reversing in the opposite direction. They push price to those liquidity zones and then reverse their orders the other way around. So the areas where you can find these stop hunts are in situations where you find fake breakouts, where price breaks a level and then retail traders are trapped before the price reverses the other direction. Also, you can see it as liquidity sweeps, where a scenario whereby price spikes beyond the key level and then triggers the stop losses around that key level, then moves back the other way around. So we are going to do some examples on the charts. Here is another tip for you guys: always wait for confirmation before entering after a breakout. Always wait for probably a change of character or your candlestick formation before you take a trade after a breakout. Don't forget to like, subscribe and turn on notifications so you never miss a powerful trading lesson next time. Okay, now how do we trade liquidity grabs and stop hunts? First, we identify liquidity zones, which are our previous highs and lows, or our support and resistance levels. Okay, so let's do an example of that. Alright, so you need to mark out your previous highs and lows on the chart. For example, you notice the price keeps coming to this level. Let's use our path tool there. Price came to this level, reacted to this level, went to this level again, came back, reacted to this same level, went higher, reacted to this same level, went a little higher, reacted to the same level again. So like we were saying just now, this is a liquidity zone. This is a liquidity zone. This area where price keeps reacting to, we have buyers here. The buyers bought, price came down, grabbed liquidity here and took them out, went all the way up, took out these sellers that were selling here, grabbed liquidity above their sales, came back to the downside, took out these buyers who were buying here, grabbed liquidity and went up again. You see, those key levels are where you find liquidity on the charts. Yeah. Now, the second step is for you to wait for price to grab liquidity, or for you to see rejection on those key levels on the chart. So if we were to take these trades in here, all we'll have done is, like I said earlier, first we mark out those key areas. Okay, so we have this zone here. I'm going to have to use the smaller time frames. Then we have this high here as well. Okay, and we have this highest high here. Then we also have this. Okay, so if we were to trade in here, now this is a demand zone here. When price came all the way from up here, came all the way down here, created liquidity, consolidated, came and took out all of the buyers that were here. After that liquidity grab, you see price went back inside, giving a rejection candle. So in here, we could take in our trade right away, because price just grabbed liquidity below a support level, taking out the previous buyers here, and then we see a rejection candle. Right away, we take our buy order immediately and then target the next obvious high, which is this here, or we could use 50% of the whole zone that was broken down. You can use 50%. You can see 50% from this level that was taken out. So we could target this high here, and you see that price definitely took out that high here. So that's one example there for you guys. Okay, so if we were to trade probably this short sell to this side, all we'll have waited for was for price. Okay, so take for example where price was at this level. Now this high has been taken out after we took the buys here, and then we have another resistance level here. Then we wait for a reaction back. Probably we are still in the same trade from down here, and then price rolled all the way up here. So if we were to take this sell, we might have missed this because price has not grabbed liquidity yet. So we wait for the pullback first, then another buy to the upside. Then the moment we see this liquidity grab, we are in for the sells again, riding it to the next support level, which is here. There's another support level here. So the moment price grabbed liquidity above this high, you could have taken in a short there, a short position immediately, and then target the next support level. The next support level. So that will have been a risk reward of 2.5 for us. So it's pretty that much simple, guys. Even this occurs on the lower time frames as well. I'm showing you on the higher time frames so you can get to see it clearly. But let's do something on this lower time frame so you can see, because liquidity grabs occur more on the lower time frames. So if you look here well, you see price took out this high before the drop. Then again, price took out this low before the buy. So at those previous highs and lows, you see that the big players keep taking out retail traders before they go in the main direction. The direction was a buy, but then they swept out liquidity there, and immediately you see momentum pumped into the market. You see those big candles. That is to tell you that the market makers are now in the game. So that's how it works, guys. Liquidity grab and then a move to the other way around. You see this is also a liquidity grab here as well. Liquidity grabs occur at those previous highs and lows. See, this was a previous low here. The price grabbed liquidity below it and then swiftly moved to the upside, although this was a slow movement. But immediately here as well, you see on the lower time frame, all these areas where you see rejection is more of a liquidity grab where you move to the lower time frames. Let's mark this so you can see it. Let's use the 15 minutes chart. If you look well, you see we had a previous low here. Let me use this. We had a previous low here. Then price swept it out, changed character in here, and then continued the buy. After the liquidity grab, we had a change of character, and then boom, the market makers came in, and then price continued shooting higher and higher. So whenever you want to take your trades, make sure you first of all mark out the past high and low on the charts there, and then wait for the market makers to sweep out liquidity. Right after they sweep out liquidity, you will see volume kick in the markets immediately. You can see those big moves start right after liquidity is swept. Okay, so don't forget to like, subscribe, and turn on notifications so you never miss this kind of trading lessons next time. Alright, so another pro tip for you guys: use a tight stop below the liquidity grab to minimize risks. So whenever you're taking a trade, make sure to use the liquidity grab, which is the rejection candle, as your stop loss, so you don't have big stop losses when you place your trades. Like I said, you target the next resistance or support levels. Yeah. So now understanding liquidity and stop ons is the key to trading like these pros. If you want to trade like the big banks, you need to understand liquidity very clearly. Alright. So once you master this, you stop getting trapped by the market, and then you start trading with the institutions and not against them. So I want to hear in the comment sections, let me hear you all in the comment sections, if you have ever been stopped out by stop ons and then the market turns the other way around. Let's have a chat in the comment section. Don't forget to like, subscribe, and turn on notifications so you never miss a powerful trading lesson next time. Alright, bye for now and peace out, guys.